Okay, let's get into it. We're doing a deep dive on Samsara's Q3 fiscal year 2026 earnings call.
Ticker IoT. This covers the quarter that ended back on November 1st, 2025.
Right. And our mission today, as always, is pretty straightforward. We've gone through all the prepared remarks, the Q&A, the whole thing, to pull out the core story for you.
We're looking at the actual results, the big strategic moves, and what it all means going forward.
Exactly. If you want to know why the market reacted so strongly to this, you're in the right place. Because, this was just a quarter of powerful execution. You could feel the momentum accelerating.
It really felt like an inflection point. You heard management say it over and over. This quarter validated their whole thesis, durable growth, but now with newfound efficiency.
So let's start with those headline numbers, the ones that, really got everyone's attention.
They didn't just meet expectations. They blew past them. On profitability, non-GAAP EPS was $0.15.
And the consensus was what, like $0.12?
Exactly. 12 cents. So that's a 25% beat right out of the gate. The market loves to see that.
Okay, and that's the bottom line. What about the growth engine, the top line? Revenue has to stay strong for a name like this.
Oh, absolutely.
Yeah.
Revenue came in at $416 million. That's 29% growth year over year.
So another beat.
A pretty big one, yeah. About $16 to $17 million ahead of what analysts were expecting. But, we always talk about the quality of that growth.
Which takes us right to the bedrock metric for any subscription business, annual recurring revenue. How did the ARR look?
The ARR was solid. It ended the quarter at $1.745 billion, which is also up 29% year over year. But here's a really interesting part.
Go on.
The net new ARR they added in the quarter was $105 million. And that was the highest net new growth rate they have seen in 7 quarters.
7 quarters, so it's accelerating.
It suggests the investments in sales and new products are really starting to pay off, right, when they're also hitting these efficiency goals.
And speaking of efficiency, we have to talk about the milestone that really dominated the headlines, GAAP profitability.
For the very first time, GAAP EPS of 1 cent.
So for anyone listening, why is hitting GAAP profitability, even just by a penny, such a massive signal? Especially for a high-growth software company.
Well, it signals maturity. It proves the underlying business model works. Non-GAAP numbers, they exclude big costs like stock-based compensation.
Which is huge for these tech companies.
It's massive, but GAAP is the true all-in measure. Hitting that 1 cent means they can grow revenue at almost 30% and still cover all their costs.
Right.
It changes the story from growth at any cost to growth with discipline.
That's a great way to put it. And that discipline really shows up in the margins, right? The operational efficiency.
The story there is frankly stunning. The non-GAAP operating margin hit a record 19%.
A record 19%. What was it last year?
That's the thing. It was 9 percentage points lower last year. So that's a huge expansion. It shows incredible operating leverage. Costs are just growing way slower than revenue.
And that leverage turns into cash.
Immediately. And cash is king. Net cash from operations hit a 15% margin. Adjusted free cash flow was at a 13% margin. Both of those are up 4 points year over year.
So they're printing cash while accelerating growth.
And hitting GAAP profit. So what you call an and quarter, not an or quarter. They did it all.
Okay, so the efficiency part is locked down. But that only really matters if they keep landing bigger customers. This brings us to their whole enterprise narrative, right? They're going after the whales.
Yeah, and it's clearly working. They added a record 219 customers with over $100,000 in ARR.
A record.
Yeah. And that brings their total in that, high-value group to almost 3,000 customers.
And that group, the 100K plus customers, they now make up over $1 billion in ARR.
Right. And get this, that specific cohort grew 36% year over year.
Which is much faster than the overall company growth of 29%.
Exactly. It shows the growth is high quality. It's coming from these big, sophisticated companies that are way less likely to churn. They also added 17 new $1 million plus ARR customers.
Tying a record. And you saw some huge names in there. The state of New York, Cadent Gas in the UK. These are mission-critical wins.
They are. And it proves out their platform approach. They're not just selling a single gadget.
So let's talk about that, the multi-product flywheel. How well are they actually landing customers on more than one product?
It's the core of their strategy, and it's working. Over 95% of those big customers use 2 or more products.
And what about 3 or more?
About 70%. And that's what creates the stickiness, reduces churn, it expands what they call wallet share.
And that has to be driving up the deal size, the ACV?
It is the annual contract value. Just look at their biggest deals. 9 of their top 10 net new ACV deals included 3 or more products,
So the sales team is leading with the platform.
right? Not just one piece of it. Yeah. There was this great example with a big home improvement retailer. They expanded their safety and telematics licenses, but then they added connected workflows on top of that.
So it's not just an upsell, they're embedding themselves deeper and deeper into the client's actual day-to-day operations.
That is land and expand working perfectly.
And under all of this is innovation. In today's world, that means AI, but, we hear a lot of AI buzz. Did they show how it's actually making them money?
They did. And this might be the most important metric of the whole call. A full 20% of their net new ACV came from products launched in just the last year.
20% from brand new products.
It's a huge acceleration. It shows that new stuff like AI Multicam and connected training, it's getting adopted really, really quickly. Asset tags was another one.
The asset tags use case really stood out to me because it shows them moving beyond just, trucks on a map.
Totally. The ARR from asset tags grew over 400% year over year.
400%.
Yeah. They landed their biggest asset tag deal ever with a global chemistry company. This company, they needed to track thousands of these reusable chemical totes.
So not vehicles, industrial assets.
Exactly. By putting Samsara's tags on them, they got real-time visibility, and the ROI they're projecting is just massive, a 25% improvement in fleet efficiency, and they think they can cut their manual inventory labor by over 90%.
That's the kind of ROI that makes product non-discretionary. It also shows they're successfully expanding their addressable market.
And they're doing it by integrating it all. The fleet, the driver safety, and now the asset tracking. It's all on one platform, and that's the real differentiator.
Which brings us to safety. They put out a safety report with one statistic that was, frankly, staggering.
The 73% number?
The 73% reduction in crash rates.
Exactly. They found that fleets using their AI cameras and coaching tools saw, on average, a 37% drop in accidents after just 6 months.
Okay, that's already great.
But after 30 months of use, that reduction grew to 73%.
Let's just sit with that for a second. 73%. In a world where commercial insurance premiums are going through the roof, that kind of number changes the whole conversation.
It does. It shifts the platform from a nice-to-have to a must-have. It's a solvency tool. It gives you a clear, fast payback period by slashing your biggest cost outside of labor.
It's a definitive financial argument.
And they're leaning into it. They just launched a new product in November, commercial navigation, an AI-supported truck routing system.
And this isn't just like Google Maps for trucks. It's way more integrated.
Way more. It's tied directly to the driver's hours of service data. It knows the truck's height, weight, if it has hazardous materials. So a dispatcher doesn't have to juggle 5 different systems. It's all there.
Which again pushes out those point solutions and makes their platform the one system of record.
Precisely.
So the platform is getting stickier. Where are they finding the new growth? What about new verticals or geographies?
2 areas really jumped out. First, the public sector. It had its highest ever mix of net new ACV this quarter.
How much did it grow?
About 100% year over year. Yeah. Huge wins with state and local governments who are finally seeing the efficiency gains.
And what about internationally? Is there enough runway there to keep this growth rate up?
It certainly looks that way. International contributed 16% of net new ACV, and the growth rate in Europe accelerated for the second straight quarter.
So Europe is picking up steam.
It is. It's at its highest growth rate in 7 quarters. And management was very clear on this. Markets like Europe, Canada, Mexico, they are way less penetrated than the U.S., and it's a huge long-term opportunity for them.
Okay, so let's put it all together. You have a quarter of really operational perfection, record scale, first GAAP profit, new products are firing on all cylinders, and you have these big growth runways internationally and in government.
A pretty clean story.
So let's pivot to the future. What do they guide for the next quarter and the full year?
Well, the strong performance led to a pretty meaningful guidance raise. For Q4, they're expecting revenue between $421 and $423 million.
Which implies what kind of growth?
About 22% year over year at the midpoint, and non-GAAP EPS is guided to 12 to 13 cents.
And for the full year?
They raised the full year non-GAAP EPS guidance to between 50 and 51 cents. That's about a 10% raise from their last guide, which reflects all that operating leverage we talked about.
Okay, but here's the nuance, right? The potential risk. The full year raise is great, but that Q4 revenue guide, the 22% growth, that's a step down from the 29% they just reported.
It's a deceleration.
A pretty clear one. So how did management talk about that? Did they address the variability?
They did. And it's a really crucial point for you to understand. They were explicit that as they move up market and chase these even bigger enterprise deals,
The whales.
the whales, exactly. It just introduces more variability into the quarterly results. These massive deals have longer, much less predictable sales cycles.
So the trade-off is lumpier quarters in exchange for bigger, stickier, higher quality revenue.
That's the trade-off. And the big question for investors is, can they manage that? The takeaway seems to be that it's the right move, as long as they keep that efficiency up.
They're becoming a growth at scale company.
Yes. And they're tapping into these non-discretionary budgets. Over 80% of their revenue comes from operations budgets, not IT. So it's very durable. But the tension now is between that top-line growth rate and the predictability of the business. That's the debate going into next year.
That's a perfect summary. Okay, so now we get to our favorite part of the show, the segment based entirely on the source material we just covered.
And we have to say it again.
We do. This is not financial advice. We are not investment professionals. Please do your own homework before making any investment decisions.
Seriously. With that out of the way, I do have an outrageous but plausible trade idea that comes directly from this earnings call.
I'm ready. Lay it on us. What's the setup?
The setup is a long-term pairs trade. You go long Samsara, so ticker IoT, and you go short the commercial insurance market.
Long IoT, short commercial insurance. Okay, explain the logic there.
The logic flows directly from that 73% crash reduction statistic we talked about.
Right, over 30 months.
Over 30 months. That is a statistically overwhelming reduction in risk. So the trade is this. Over the next 5-10 years, as this kind of AI safety tech becomes standard, maybe even mandatory.
Which seems inevitable with numbers like that.
It seems inevitable.
Yeah.
The core risk pool that commercial truck insurers underwrite is going to shrink. Their ability to price risk, their long-term profitability, it gets fundamentally damaged.
So you're betting that the technology will basically digitize and eliminate the physical risk that the insurance industry profits from.
That's the bet. You're long the platform that's creating the safety outcomes, and you're short the industry that's going to face shrinking margins because that safety becomes ubiquitous. It's a direct line thesis from technology disrupting finance.
A fascinating and definitely an aggressive idea. It puts that 73% number in a very sharp financial light.
It does.
All right, to wrap up this deep dive, Samsara delivered a true milestone quarter. They hit record scale, their first ever GAAP profit, showed amazing operating leverage, and they raised their full year guidance in a big way.
This story is all about successful execution with large enterprises and tapping into those durable, non-discretionary operations budgets.
So here's the final thought we want to leave you with. Management proved they can execute and be efficient at the same time. The question is, with Q4 guidance pointing to a top-line growth slowdown into the low 20s, can they offset that? Can the fast-growing international markets and all this AI-driven wallet share gain keep the momentum high enough to justify the stock's premium valuation?
That's the story to watch now, the tension between growth and scalability in that big enterprise market.
Thank you for joining us for this deep dive into Samsara's Q3 FY26 results. And remember, everything we discussed is for informational purposes only. Always do your own research. We will catch you on the next one.